Digitalization. We've all heard it called a game changer, right? But sometimes, well, that phrase can feel a little empty.
Yeah, it gets thrown around a lot.
But our sources today, they show some really undeniable proof of its power, especially thinking back to the recent pandemic stresses.
Oh, absolutely.
When mobility restrictions hit everywhere, firms that had already jumped into digitalization, they didn't just survive. Some actually saw transactions increase, customer engagement too,
And that was the hard evidence, really, that a lot of governments needed to see. It kind of crystallized this core policy drive.
which is,
Well, the goal is harnessing this digital power, not just for faster service, but to boost global productivity, make things more sustainable, and this is the critical part, foster real inclusion, especially for those who typically get left behind.
you mean groups like MSMEs, women, young people?
Exactly. The G20 even formalized this in their high-level policy guidelines back in 2020, made digital inclusion a proper global mission.
Okay, so that's the big picture. But here's the challenge, right? And this is really the focus of our deep dive today. Digitalization only works. It's only productive and sustainable and inclusive if trust and security can actually keep pace.
That's the bottleneck. If every new digital user, every bit of new data just adds more risk to the system, eventually the whole thing could just, well, grind to a halt.
So it's not enough to just roll out basic digital financial services, DFS, and call it a day.
No way. We need a whole new way to think about digital trust. A new architecture that sort of flips the current model upside down.
And that's where self-sovereign identity, or SSI, comes in.
Precisely. That's what we're diving into today. We'll start by looking at the policy drivers, the national strategies pushing for digital financial inclusion, or DFI. Then we're going to really unpack the tech behind SSI.
Things like verifiable credentials, VCs, and decentralized identifiers, DIDs.
Exactly. The stuff that promises to give the internet that missing layer. A secure, scalable personal identity layer that, frankly, it's needed for decades.
Okay, let's start right there. Who are we talking about? Who's being left out of this digital transformation, and crucially, why?
Our sources paint a really clear picture, unfortunately. We're talking about the poor, obviously, but also youth, people in remote areas, and significantly women.
And the barriers, they're not just about not having a smartphone, are they?
Oh, not at all. They're deep. Structural, socioeconomic, sometimes political.
Yeah.
Let's take women-owned businesses as a prime example. The challenges for them are just layered.
How so?
Well, often it starts with the absolute basics. Lacking the legally recognized financial ID documents you need just to open an account or apply for a loan.
And I imagine it goes beyond just the paperwork.
Absolutely. It ties into systemic issues of economic power, lower financial independence, sometimes lower financial literacy levels, maybe greater risk aversion because, well, their economic situation is often more fragile.
And cultural norms, too.
Definitely. Sociocultural norms can actively prevent women from accessing or controlling financial services. Think about it. If local customs mean a woman can't own property or can't travel alone to a bank branch, a fancy mobile banking app doesn't really solve that root problem, does it?
No, the policy has to tackle those deeper issues alongside the tech rollout.
Precisely.
We saw some interesting data points that really pinpoint where digital solutions could make the biggest difference.
Yeah, that data is revealing. If you look at SMEs generally, the big draws are things like cash management, payments, remittances, pretty predictable stuff.
But when you break it down,
When you disaggregate that data, focus on specific vulnerable groups, the picture gets much sharper. Look at women entrepreneurs in that data. There's this huge spike, a real urgent unmet need specifically under payments.
so that tells policymakers.
It tells them very clearly that secure, low-cost, easy-to-access digital payment solutions. That's the immediate priority if you want to drive inclusion for women. It's not just a nice-to-have. It's a critical operational need backed by data.
Okay, so governments see these systemic barriers. They see the data. How do they turn that understanding into real action, into a national strategy?
Well, the policy imperative, the advice coming from these global frameworks we looked at, is for every country's financial authority to do a really detailed, honest look at their own financial landscape. Pinpoint exactly who is underserved and why,
And then,
Then, those insights, driven by data, need to feed directly into a solid national financial inclusion strategy, an NFIS. And crucially, this can't just be a government thing dictated from the top down.
needs private sector buy-in.
Absolutely. You need active participation, partnerships with banks, fintechs, telecom companies, everyone involved in the ecosystem.
We did see some really creative national approaches that moved pretty quickly from that strategy phase to actually doing something. Mexico's CODI system, for example.
Ah, yes, Cody.
Hmm.
Mexico's central bank started developing Cobro Digital Cody way back in 2017. The concept was pretty revolutionary in its simplicity.
How does it work?
It's a payment scheme for secure digital transactions using QR codes or NFC, tap to pay. But the key thing, it's completely free for both the user and the merchant.
Zero cost. That's huge.
It is. The explicit goal was pushing towards a cashless economy, getting around those often prohibitive fees you see with card networks or traditional bank transfers.
And what really stood out for me with CODI wasn't just the tech, but the transparency they built in.
You're spot on. The Mexican government knew that if you want to improve inclusion, you have to measure it constantly. So they launched this real-time progress monitoring platform.
Tracking the NFIS.
Exactly. Using frequent surveys, hard data, keeping everything transparent and accountable. And that evidence-based approach, combined with Cody's low barrier to entry, is credited with making a real dent in the gender gap for financial inclusion in some areas.
Proof that consistent measurement really matters.
It's inclusion's best friend, truly.
Then you've got Nigeria taking a different route, arguably even more radical, launching the Naira, a central bank digital currency, a CBDC, back in October 2021. Why jump straight to a CBDC?
Well, Nigeria had a really tough, stubborn inclusion problem. When they launched, only about 45% of Nigerians even had an account with a formal financial provider.
Wow, that low.
Yeah, and the problem was particularly bad in the less developed northern regions and disproportionately affected women and lower income groups, people who maybe didn't live near a bank or didn't have much trust in the traditional system.
So the motivation was just getting payments working better?
Pretty much. They needed faster, more reliable, much more efficient payments. And they needed a system that could reach more people, get more usage than the existing commercial banks seemed able to deliver on their own.
So how does the Naira's design specifically try to reach those unbanked groups?
It uses a two-tier system. The Central Bank of Nigeria, the CBN, issues the digital currency, but it's distributed through commercial banks and licensed payment service providers.
Okay, so it still involves banks.
Yes, but the design allows the government to essentially lower the bar for entry on low-value accounts. Users can get onboarded with minimal ID, sometimes just their phone number. It creates this direct digital pathway.
A more resilient payment rail, maybe?
That's the idea. A robust system designed to pull those unbanked groups, especially in those remote northern areas, into the formal financial system faster than waiting for new bank branches to be built ever could.
Okay, so we've got the policy push, the national strategies like CODI and Naira. Let's shift to the specific products and tech making DFI happen beyond just basic payments, things like APIs, big data, biometrics, DLT, open banking.
Open banking is a really powerful one for inclusion. It fundamentally changes how financial data gets used.
How so? It breaks down the silos.
Exactly. Traditionally, your bank holds your data tight, right, in a silo. Open banking, usually pushed by regulators, allows authorized third parties, could be a fintech, could be a microfinance group, to access that customer data held by the bank, with the customer's explicit consent, of course.
And what does that unlock for someone who's currently underserved?
It enables a potential explosion in product suitability. Imagine a small fintech getting permission to see your transaction history. They could use that insight to offer you something hyper-tailored.
Like,
Maybe a microinsurance policy designed for a farmer with really seasonal income.
Huh?
Or a tiny investment product perfect for a young person with a small but steady wage. It moves the needle from standardized, one-size-fits-all bank products to truly personalized financial solutions based on how people actually live and spend.
but despite all this cool tech, this digital wave, there's still that one big stubborn barrier: cash. That
Right.
strong cash culture in so many emerging economies.
Oh, yeah. That preference for physical cash is probably the single biggest behavioral hurdle. It's about deep-seated trust, habit, inertia.
people trust what they can hold in their hand.
Exactly. Overcoming that psychological barrier, even with systems like Cody offering free, secure digital payments, takes a massive ongoing effort in financial education and building consumer confidence. You need regulatory innovation and strong public education campaigns working together.
Which brings us neatly to the whole regulatory balancing act. Right, this is where it gets tricky, isn't it? Innovation races ahead, but regulators have to manage risk, make sure the system stays stable, secure, and actually includes people fairly. It's a delicate balance.
And the key principle guiding that balance is regulatory proportionality,
Maybe.
meaning you apply rules and requirements based on the actual risk. You look at the size, the complexity, the risk profile, the type of product or provider. You can't slap the same heavy rules designed for a huge global bank onto a small local microfinance outfit.
Because that would just stifle them.
It would choke off the very inclusion-focused services you're trying to encourage.
Can you give us a real-world example of that?
Malaysia is a classic case. When they implemented the big global banking standards, Basel III, things like capital and liquidity rules, they applied them strictly to the big commercial banks.
Well, if not to everyone.
Exactly. They explicitly didn't apply those same strict rules to their development finance institutions, the DFIs.
Why the exception? What was the logic?
Because the regulators understood the DFIs have a specific job, a developmental mandate. They exist to provide microfinance, microsavings, loans to SMEs, often in riskier areas, or for people the commercial banks won't serve.
So their mission requires taking on certain risks.
Right. Applying Basel III rigidly would have stopped them from doing their job, fulfilling their development and inclusion goals. It shows smart, proportional regulation taking global rules but tailoring them to national needs.
And that proportional approach seems absolutely vital when you think about non-bank providers, the PSPs, microfinance groups, fintechs. Often they're the ones really driving inclusion on the ground. How do you regulate them effectively?
By creating clear, flexible rules that recognize they aren't traditional banks, we're seeing good examples in places like Uganda, Ethiopia, Pakistan. They've each created a separate category just for e-money issuers who aren't banks.
Why is that specific category so important?
It brings them into the regulatory fold, so you get AML compliance, consumer protection, but it gives them the flexibility they need to operate and innovate without needing a full high-capital banking license. They're regulated based on their activity and risk, not just what kind of company they are.
Now, regulators know tech moves faster than rulemaking cycles. So they're using tools like sandboxes and innovation offices to try and keep up, to allow controlled experiments.
Yeah, these are becoming essential tools for structured engagement. Look at Japan's Financial Services Agency. They set up a fintech support desk for consultations, helping firms navigate the rules, and a proof of concept hub to support testing of really new, unprecedented tech.
Safe spaces to try things out.
Pretty much. Co-creation spaces. Brazil's central bank did something similar with their BCB sandbox, letting firms test novel solutions, including inclusion-focused ones, under relaxed rules for a limited time.
And the regulators get real data on the risks before something gets rolled out nationwide.
Exactly. It helps bridge that gap between innovation speed and regulatory caution.
Okay, let's pivot now to the data itself. The whole promise of DFI hinges on using lots of data, especially alternative data, to build profiles for people without formal credit histories. But using all that data creates its own huge risks.
That's the fundamental tension, isn't it? The necessary evil, almost, of modern credit scoring. We need alternative data utility bills, mobile phone payments, supplier payment histories to give people like young entrepreneurs or small business owners a chance when they lack a formal credit score.
But collecting all that data,
It creates these massive honeypots, huge targets for cyber attacks. Regulators absolutely have to demand strong security, clear rules on encryption, real-time breach monitoring, strict policies on how long data can even be kept.
and it's not just about security breaches, is it? There's a more subtle risk with the analysis itself, particularly with AI and machine learning.
Oh, definitely. Machine learning models are popular with fintechs for credit scoring, but they can learn and reproduce biases present in the historical data they're trained on, even without any human deliberately coding in bias.
How does that happen?
It's like a feedback loop. If the model learns from past loan data where certain groups were systematically denied credit, maybe unfairly, the algorithm essentially learns that denial is the right answer for people with similar characteristics.
So it ends up discriminating against the very people you're trying to include.
Exactly. It can create these self-fulfilling prophecies of exclusion. It's not necessarily malicious, but the outcome is unfair, and that demands regulatory intervention.
So how can regulators police an algorithm?
They need the authority to mandate regular testing and validation of these scoring models, specifically checking for unfair bias against protected or underserved groups. This can't just be a tick box exercise. It has to be part of regular checkups,
Looking under the hood of the model.
inspecting the inputs, the logic, the outcomes. And beyond that, regulators should be looking at techniques like differential privacy.
Differential privacy. Sounds technical. Break that down for us. What is it and how does it help protect people?
Think of it like adding carefully calculated statistical noise or fuzziness to a data set before it's analyzed.
Adding noise. How does that help?
The noise is added in a mathematically precise way. It means researchers can still see the big picture, the overall trends, like, say, the percentage of young people in a region opening savings accounts. But it makes it mathematically impossible, or at least extremely difficult, to link any specific data point back to an individual person with high confidence.
So you get the insights without compromising individual privacy.
That's the goal. It's a way to try and balance the need for data analysis with the fundamental right to privacy, especially when dealing with huge, sensitive data sets.
Speaking of protection, let's talk about consumer protection more broadly in this digital age. What are the specific new risks consumers face now?
Well, you've still got the traditional risks like fraud or misconduct by the fintech operator, platform vulnerabilities, cyber attacks, but the newer risks often revolve around information asymmetry. Lack of clear, transparent disclosures, products being sold that are too complex or unsuitable for the customer. And as we just discussed, algorithmic decisions leading to unfair outcomes, often with no clear way for the consumer to appeal or even understand why they were rejected.
We heard some regulators are using behavioral insights to tackle this, not just writing abstract rules. How does that work in practice?
It kind of shifts the burden onto the provider, the FSP. Brazil's a good example again. Their regulators require financial service providers to actively assess their customer base for potential vulnerabilities.
What counts as a vulnerability?
It could be people in remote rural areas with spotty internet, or maybe customers identified as having lower levels of digital financial literacy. The FSP then has to adjust how they communicate, what disclosures they provide, maybe even the products they offer to those groups.
Trying to prevent people from being sold something confusing or inappropriate.
Exactly. It's a risk-based approach aimed at protecting those least equipped to navigate the complexities of digital finance.
And all of this really underscores the need for digital financial literacy.
Absolutely critical. And it's not just about knowing how to use an app. We define digital financial literacy as the whole package. The knowledge, skills, attitudes, and behaviors needed to use digital financial services safely and effectively.
Making informed decisions.
Right. Brazil's central bank, again, did a great job when they rolled out their instant payment system, Pix. They didn't just launch the tech. They put out over 30 videos, hundreds of social media posts, all explaining how Pix works, the risks, how to use it safely.
Proactive education.
Yeah. And it built tremendous public trust, led to incredibly fast adoption. It shows that collaboration between the regulator and the public is key.
Okay, so we've established that DFI needs trust and security to scale up. And relying on the old ways, big central databases, just tweaking existing regulations, isn't really enough, is it? Because of the data risks involved.
It's fundamentally insufficient. The old models of digital identity just weren't built for the world we live in now.
What was wrong with them?
Well, think about it. As Kim Cameron, who is Microsoft's identity guru, pointed out, the internet wasn't built with any native way to know who or what you're actually connecting to. That vacuum, that lack of an identity layer, is what led to all the problems we see. Theft, deception, this constant erosion of trust.
And the old models tried to fill that gap.
Yeah, but imperfectly. Centralized models, where one company or government holds all your identity data, they're just giant honeypots, massive targets for hackers. Plus, your data isn't really yours. You can't easily take it with you. It's not portable.
And the federated model, using, say, your Google or Facebook login.
A bit better for convenience, maybe, but it doesn't solve the core privacy or security issues. Those big platforms still become huge honeypots. And critically, they can't securely handle really sensitive, high-value stuff like your passport details, your health records, complex financial certifications. The privacy risk of them holding all that is just too immense.
So SSI emerged to fix this fundamental failure.
Oh, exactly. The core philosophy is incredibly simple but radical. Identity control must belong to the individual or the entity itself, full stop.
So it's not just a fancier login system. It's a shift in who's in charge.
It's a complete flip of the traditional model. SSI is all about you, the individual, selectively disclosing bits of your personal information. Only what's needed on a need-to-know basis, but being able to do that at massive scale.
And it's not just for people.
Nope. It applies equally to organizations, to devices, to things, anything that needs a secure, trustworthy identity online. It's aiming to provide that secure, private, foundational trust layer the internet has always lacked.
Okay, let's get into the nuts and bolts. How does it actually work? We have to start with verifiable credentials, VCs. What are they?
Think of VCs as the digital equivalent of your physical credentials, like your driver's license, your university diploma, your professional certification, but with superpowers.
Superpowers.
Well, they're digital data snippets that make a claim about you. You graduated, you're over 18, you have this particular skill, but crucially, they are tamper-proof and cryptographically signed by the issuer, and they can be verified instantly.
How does that verification work? You mentioned a trust triangle.
Right. It's a simple model to understand the flow. First point of the triangle, the issuer. That's the authority making the claim, the government issuing the license, the university issuing the diploma, the bank confirming your address. They cryptographically sign the VC.
Okay, issuer. Point two.
Point two is the holder. That's you, the individual or the organization. You receive the VC and store it securely in your digital wallet under your complete control.
Got it. And the third point.
The verifier. That's the party who needs to check the claim. Could be a website verifying your age, an employer verifying your degree, a pharmacist verifying your prescription.
So the verifier doesn't need to call the university or check some central database.
Yeah. Exactly. That's the magic. The verifier checks the VC directly by verifying the issuer's cryptographic signature on it. If the signature is valid, they know instantly that the credential is authentic, it hasn't been tampered with, and the issuer stands behind that claim.
And I, the holder, only reveal the specific information needed for that interaction.
Precisely. You prove what's necessary without oversharing and without relying on a vulnerable central database.
Okay, but for VCs to work, all parties, issuer, holder, verifier, need a secure way to identify each other, right? Which brings us to decentralized identifiers, DIDs.
DIDs are the absolute foundation. They're the addresses of this new trust layer. Think of a DID as a globally unique, permanent digital address that you and only you control.
Like a phone number or email address I own forever.
Sort of, but much more secure and decentralized. No central registry, no domain registrar, no certificate authority can take your DID away or revoke it. They eliminate that reliance on centralized choke points. That's why DIDs are layer one, the base of the whole trust over IP stack we mentioned.
So DIDs let any two parties connect securely.
Just like IP addresses let any two devices on the internet talk, DIDs let any two identity owners, people, organizations, things, establish a secure, private, mutually verifiable connection.
And managing all this, the VCs, the DIDs, the connections, happens through the user's digital wallet in their agent.
Correct. The wallet is your personal container. It holds your private keys, the things that prove you control your DIDs, and it holds your received VCs. It's where your digital identity lives, under your lock and key.
And the agent, what does that do?
The agent is like your smart digital assistant working behind the scenes. It automates the complex stuff, it handles the secure handshake, the mutual authentication with the verifier's agent. It negotiates what proof is needed based on the rules. It presents the right VC from your wallet when you give the okay.
So it makes these interactions seamless.
Ideally, yes.
Yeah.
If the issuer and verifier also use agents, the whole process of proving who you are or proving some fact about yourself becomes almost invisible. Fast, secure, automated, and crucially auditable by you, the user.
We saw a real-world glimpse of this need during the pandemic with digital vaccine credentials, didn't we?
Absolutely. The surge in demand for things like the WHO Smart Vaccination Certificate or the IATA Travel Pass showed that people need portable, verifiable, privacy-preserving ways to share specific health information. The need for SSI isn't theoretical. It's already here.
Okay, this sounds incredibly powerful, but it all seems to hinge on keeping those private keys safe. You lose your key, you lose your identity. That feels like a huge vulnerability, the Achilles heel. How do we manage that risk?
You've hit the nail on the head. That was the historical Achilles heel of cryptographic identity. Protecting those keys is paramount. Solving this required developing robust, decentralized key management systems, DKMS.
So better ways to handle keys.
Yes, and moving beyond the idea that one single key controls everything. And a key technical realization here, which is massive for scaling this whole thing up, is that DIDs don't always need a public blockchain or ledger to work.
Wait, really? I thought blockchain was essential for decentralization. You're saying DIDs can work without it?
For many use cases, yes. We can use something called peer DIDs.
Peer Ds.
Basically, the DID and its associated document, the thing with the public keys and service endpoints, can be generated locally and exchanged directly between two parties over a secure private channel, peer-to-peer.
What's the advantage of that?
Huge advantages, much better scalability because you're not writing to a shared ledger, instant performance, and complete privacy because your DID and your public keys are never broadcast or logged on any public system. They're only shared with the parties you directly interact with.
Okay, that helps with performance and privacy, but it doesn't solve the lost key problem. If my keys are just on my device and I lose the device.
Right. Key recovery is still absolutely essential. The promise has to be that a well-designed digital wallet is safer and more recoverable than your physical wallet.
So how do you recover a key if there's no central admin, no password reset?
There are two main approaches gaining traction. The first is pretty straightforward. Automatic encrypted backup.
Like backing up to the cloud.
Exactly. Your wallet continuously backs itself up in an encrypted state to cloud storage. To restore it, you need a recovery key or a passphrase that only you know. But you absolutely must keep that recovery key safe, maybe offline, because again, there's no help desk to call if you lose it.
Okay, so secure backup. What's the second method?
The second is more sophisticated and often seen as more robust. Social recovery.
Social recovery. That sounds interesting.
Yeah.
Bringing other people into it. How does that work without creating new security holes?
It uses a clever cryptographic trick called key sharding. Imagine your main recovery key is split into several pieces, say 5 fragments.
Like pieces of a puzzle.
Exactly. And the system is set up so you might need, say, 3 out of those 5 fragments, that's the M of N part, like 3 of 5, to put the key back together. You then give each of these fragments to trusted connections, your trustees.
Friends, family.
A lawyer. Could be any combination you trust. If you lose your device and your primary key, you contact at least 3 of your 5 trustees. They provide their fragment back to you, or rather to your recovery software. With those 3 fragments, the cryptography lets you reconstruct your original recovery key and regain access to your wallet.
That raises a flag for me, though. Aren't we just replacing trust in a big company with trust in 3 friends?
Mm-hmm.
What if I fall out with my trustees? Or what if they lose their fragment, or I can't reach them when I need them?
That is a critical question and a very valid concern. The design of the social recovery system and the governance around who can be a trustee is crucial. Yes, you are placing trust in those individuals.
So how is it better than trusting Google?
Well, a few key differences. First, each trustee only holds a fragment, which is useless on its own. They can't steal your identity with just their piece. They'd need to collude. Second, you choose your trustees, and good systems allow you to change them over time if relationships change. Third, the process is still ultimately controlled by you initiating the recovery. It distributes the trust instead of concentrating it. But yes, choosing reliable trustees and keeping that list updated is vital for this to work well. It's a human element, but managed cryptographically.
Okay, let's take these SSI concepts, decentralized control, verifiable proof, and see how they apply in the real world, especially in areas like regulation technology or RegTech. It seems like there are huge opportunities here, particularly for simplifying things like AML and KYC checks.
Oh, massive. Think about current KYC, know your customer. It costs banks and financial institutions a fortune, right? Millions, sometimes billions globally every year. And it's often repetitive. You provide the same documents over and over to different places. SSI can streamline this dramatically. Instead of the bank doing a full, costly KYC check every time, they can rely on a verifiable credential, maybe one issued by a trusted government agency or another bank that already did the full check.
So the bank just verifies the credential.
Exactly. They verify the VC comes from a trusted issuer and hasn't been tampered with. The Pan-Canadian Trust Framework, the PCTF, explicitly talks about aligning the assurance levels of VCs and DTDs with full KYC requirements. It shifts the burden, the cost, and effort towards the initial credential issuance, not repetitive checks by every single verifier.
That could save enormous amounts of time and money. And you mentioned it could change how regulation is enforced, too, moving beyond spot checks.
Yeah, this is really interesting. Imagine SSI agents transforming enforcement. Right now, it's often after-the-fact spot check auditing. Regulators look at logs weeks or months later.
Trying to catch problems after they've happened.
With SSI agents, it could become a real-time, rules-driven monitoring activity. The agents could be programmed with regulatory rules. If a transaction or an identity assertion violates a rule, it gets flagged instantly.
So faster detection, lower enforcement cost.
Dramatically lower costs, much faster response times, and potentially much higher quality data for the regulators themselves. This potential for automated real-time compliance is a big reason why the global regtech market is growing so fast. That 23.5% CAGR figure is huge.
Let's loop back to that social aspect, the power dynamics.
Mhm.
What about coercion? A powerful verifier, maybe an employer or a government agency demanding more information than they actually need or are legally allowed. How does SSI protect the individual in that situation?
That's where the governance frameworks built around the technology become critical. They need to include specific anti-coercion measures.
Like what?
One way is to require verifiers themselves to be identified and verified members of the trust ecosystem. If a bank wants to verify credentials, maybe they need a verifiable credential proving they're a legitimate bank bound by the ecosystem's rules.
Holding the verifier accountable.
Exactly. Another technical measure is requiring that all requests for proof, the questions the verifier asks, must carry a non-repudiable digital signature from the verifier.
What does that non-repudiable signature achieve?
It means the verifier cannot later deny they asked for that specific information. If they ask for something inappropriate or excessive, the holder has cryptographic proof of that request.
Proof they can use.
Yes,
Yeah.
they could take that signed request to an ombudsman, a regulator, or even use it as evidence in court. It flips the power dynamic somewhat, making verifiers think twice before overreaching on data demands. It acts as a deterrent.
Now, how are actual governments or regions adopting this? We looked at Canada's approach, which seems quite deliberate and avoids creating a single national ID.
Right, Canada's situation is complex, multiple jurisdictions, federal, provincial, territorial, and there's historically been very little public support for a single central national ID card or system.
So the PCTF reflects that.
Completely. The Pan-Canadian Trust Framework from 2020 isn't about the government issuing IDs itself. It's a technology-neutral governance framework. It sets out rules and standards so that different digital identity solutions, potentially based on SSI, can be trusted and recognized across all those different jurisdictions.
It's about interoperability, not centralization.
Exactly. It enables mutual recognition. It aims to help everyone transition from older legacy identity systems towards SSI principles, but in a decentralized way that respects Canada's political structure. It's building the trust between systems.
Meanwhile, the EU already has a pretty strong legal framework for electronic ID with the IID's regulation. How does SSI fit in there? Does it replace IIDs?
No, not replace, more like complement. The existing IDAS regulation is actually very valuable. It provides strong legal certainty, especially around the responsibilities of trust service providers who issue digital certificates. There are strict rules about when and how those can be revoked.
So it provides a solid legal foundation.
Yes. The current thinking, the proposal moving forward, is to create a parallel trust framework using SSI that sits alongside IIDAS.
Parallel, how would that work?
The idea is IIs would continue to handle the core legal electronic identification, but the new SSI-based framework would be used for issuing and sharing all sorts of other identity attributes, things like your professional qualifications, health data snippets, educational degrees, travel documents, things beyond just proving your basic legal identity.
So leveraging the legal strength of IS for the core ID, but using the flexibility and privacy features of SSI for everything else.
That seems to be the direction. It aims to maintain the legal assurance and the crucial cross-border interoperability across all 27 EU member states that IS provides, while embracing the user control and attribute-specific sharing that SSI enables.
Okay, let's make this really concrete. Give us that aha moment scenario. Connect the dots with VCs, DIDs, privacy in action. You mentioned Emma and her healthcare experience.
Yeah. Right. Let's walk through Emma's story. Imagine Emma's traveling in Italy, maybe on vacation. She suddenly realizes she forgot her paper prescription for her hyperthyroidism medication back home in Canada.
Okay, potential panic situation.
But she doesn't panic. She pulls out her phone, opens her digital wallet. Her Canadian doctor had previously issued her prescription as a verifiable credential, a VC, and she stored it there. She walks into a local Italian pharmacy run by, let's call her Clarice.
Now, how does Clarice, the pharmacist, trust this digital thing from a Canadian doctor she's never met?
Good question. Clarice uses her pharmacy system, her verifier agent, to request proof of the prescription from Emma's wallet. Emma sees the request on her phone and approves it.
What happens then?
Instantly, Clarissa's system does 2 checks using the SSI protocols. First, it verifies the cryptographic signature on the digital prescription itself, proving it's authentic and hasn't been altered since the doctor issued it. Second, it verifies the doctor's decentralized identifier, the DID, confirming the issuer really is that licensed Canadian doctor.
All without needing to call Canada or check some international database.
Exactly. Trust is established cryptographically, peer-to-peer, or rather wallet-to-verifier. And crucially, Emma only revealed the necessary prescription details, the medication, dosage, doctor's identity, not her entire medical history, not her home address.
Okay, that solves the immediate problem of getting the prescription filled across borders.
Right.
What about choosing the actual medicine? Maybe there are different brands in Italy.
Right. Now, Emma can use a related app, maybe a medicine check app, on her phone. She scans the barcode of the Italian medicine options Clarisse shows her.
What does the app do?
The app connects to relevant databases, maybe supply chain info, regulatory approvals, but it does so using a pseudonymous identifier linked to Emma's health VCs. It's an identifier that proves she has a valid need for this type of information, but cannot be easily linked back to her real name or full identity.
So she can check the different brands, maybe their ingredients, source, certifications, without revealing who she is.
Precisely. She gets the transparency she needs to make an informed choice, checking the provenance and integrity of the medicine while preserving her personal privacy regarding her specific condition, purchase history, and even her location at that moment. VCs enable both trust and privacy throughout that interaction.
That's a powerful example. And this idea of extending identity beyond people, it leads straight into the Internet of Things, doesn't it? The IoT and the whole concept of a machine economy.
Absolutely. SSI isn't just for humans. Devices, sensors, machines, they all need secure identities too. Giving a device its own DID, controlled perhaps by its manufacturer or owner, drastically cuts the cost and complexity of managing device identity.
Compared to current methods.
Yeah, current methods often rely on weak passwords or cumbersome certificate management. With DIDs, you get robust, unique, cryptographically verifiable identity for each thing. You can rotate keys easily, verify software updates securely. It tackles a massive security headache for the IoT world.
And beyond just identifying the device, what else does it enable? You mentioned data provenance.
That's critical. If machines are interacting, exchanging data, perhaps even making economic transactions with each other, you need to trust the data. Secure deity-deity connections and the exchange of VCs between machines allow us to establish assured provenance. We can know, with cryptographic certainty, which specific machine generated which piece of data and when.
Why is that so important for things like machine learning?
Because the quality of your ML output depends entirely on the quality and trustworthiness of your input data. If you're training an AI model on data coming from millions of sensors in a smart city or a complex industrial process, you must trust that the data hasn't been faked or tampered with and know exactly where it came from. SSI provides that trust fabric.
Is anyone actually doing this yet?
Yes.
Using SSI for device identity?
Yes, there are proofs of concept and early implementations. The Austrian Power Grid APG did a really interesting PSC. They were looking at how to securely identify and integrate vast numbers of small-scale distributed energy resources, DERs.
Like rooftop solar panels on people's
That's
homes.
nice.
Or small batteries.
Exactly. Historically, onboarding and verifying these millions of tiny energy sources onto the main grid was complex and expensive, a real barrier to integrating renewables.
How did SSI help?
By giving each DER, each solar panel installation, each battery unit, its own high-assurance SSI identity credential, its own DID. This potentially eliminates that costly identification bottleneck. It makes it much easier and cheaper to securely connect these small producers to the grid and manage energy flows.
So the solar panel's DID is like its passport to participate in the energy market.
That's a great way to put it. It helps APG move towards their big strategic goal of getting 100% renewable electricity by 2030 by making the decentralized grid technically and economically feasible. #outro. So if we bring this all together, wrapping up this deep dive, I think the really critical insight is this connection. Digital financial inclusion, getting those essential services to vulnerable groups like women, MSMEs, youth. It just can't reach its full potential. It can't scale safely without this fundamental shift towards decentralizing control over our identity and our data.
It's not just a tech upgrade then.
No, SSI is more than that. It's providing the necessary infrastructure. It helps manage those thorny regulatory risks we talked about, AML, KYC costs, even algorithmic bias, while at the same time maximizing individual agency, security, privacy, and ultimately economic opportunity.
It really feels like a fundamental shift in power, doesn't it?
Yeah.
Moving away from systems where some central authority, whether it's a government agency, a domain registrar, or a big tech company, can basically revoke your access or control your data.
Exactly. It's a move towards a world where control is truly exerted by the individual, through their own private keys, managed by their own agents and their own wallets. It's about returning ownership of identity and data back to the person or entity it belongs to.
Which feels like the only sustainable way to build a genuinely inclusive digital future.
And if you think about the big architecture of the internet, people sometimes use this double hourglass analogy. You have the internet protocol, IP, as the narrow waist of the first hourglass, everything runs on top of it.
Right, the foundation layer.
Well, the idea is that this trust spanning layer, built on SSI on VCs and DIDs, forms the narrow waist of a second hourglass, sitting right on top of the IP layer. It becomes the foundation for verifiable trust online.
So the provocative thought for you, our listener, to take away today is this. What happens when every connection you make, online banking, shopping, accessing health info, traveling, even your smart devices, talking to each other? What happens when all of that can be instantly, mutually, and privately authenticated without you having to constantly give away excessive data or rely on vulnerable central parties?
Will adopting this global trust spanning layer become just as essential, just as inevitable as the internet itself became decades ago?
It's the infrastructure that might finally unlock trust at internet scale.
Something to definitely keep an eye on. Thank you for joining us on this deep dive into how self-sovereign identity is poised to remake global finance and beyond.